Hi guys, this is Ishai Breslauer, your host of the CRE Shark Eye Show. Today, we're going to talk capital markets, Los Angeles. We're going to talk a lot. We have a lot to talk about. So we have with us Shlomi Ronen, who is the managing principal of Dekel Capital. And we're going to talk about everything from raising equity, working with institutional investors, talking multifamily, ground up multifamily. There's a lot to talk about. Shlomi, thank you so much for being with us today.
Thanks for having me.
Pleasure. You know what? Before we start, digging into your story of how you started this whole thing, tell us, give us like a 2-minute elevator pitch. What is Dekel Capital is all about?
So Dekel Capital is a merchant banking platform that I started 10 years ago. We're a boutique shop that focuses on both raising capital for investors and developers, as well as investing alongside them in the multifamily space.
All right. That was short, sweet, and to the point, as we call it. You know what? Before we dig into what you guys do, everything about you, how'd you get into this game? Real estate, capital markets, private equity, advisory, everything.
So I started out with an undergraduate degree in civil and structural engineering.
Oh, wow.
Worked in engineering while I was in school, and then after school, went and worked for a couple construction companies and sat in a construction trailer across the table from developers and capital, and very quickly realized that the guys sitting across the table from me were driving nicer cars and were really calling the shots at the end of the day on what we were doing, and wanted to be in their shoes. I looked at the project manager I was working with, and he'd been in the business for 30 years, and I just couldn't picture myself being a project manager in a construction company in the future. So I, after 5 years, went back to school, got my MBA in real estate finance at USC, and really used that to transition into the capital side of the business. And I ended up working for a regional mortgage brokerage shop here in Los Angeles called George Smith Partners. I was there for 9 years up until the recession. And then, the recession the Great Recession kind of prompted me to, again, reevaluate things and think about what I want to do in the next 10 years. And, at the time, there wasn't much capital advisory business to be had. All of our clients were really focused on maintaining and sustaining and staying afloat and working out with the banks, the lenders that we were dealing with. The vast majority of them went into special servicing and special assets. So, we saw an opportunity, myself and a couple of partners saw an opportunity to actually leverage our relationships with the lenders and help them either work out or sell the notes that were not performing at the time. And so for a brief period of time, got into the note sale business. We did that for about 2 years, and then by late 2010, early 2011, the capital markets started coming back and really transitioned back to focus on raising capital for our investors, but at the same time having that experience and helping both institutional private equity groups acquire notes and our clients acquire notes essentially with equity, saw the need for equity in the business and decided to focus on both raising it and providing it.
Beautiful. I love this story. And I want to take you back for a second. The point you said in the beginning that you were in the construction side of things. You saw the developers and you saw those people who own the properties and are calling the shots. But then you moved again, like you said, into the capital markets. What was the first deal? Meaning, obviously, an engineer, a guy who does project management, a CM, a construction manager is a whole different thing. When you move in to the side of being, the development side or the investment side, you move to a whole different thing. What did you need to do at that point in order to become professional at that? And what was your first deal or your first move in order to get things done?
So I actually started out with an internship while I was in business school. And, the first thing that kind of piqued my curiosity and drew me in was the pace. So when you're working in construction and development, you're generally focused, especially on construction, you're on a project team, you're focused on one project, and that project is anywhere from 2 years to 10 years, depending on the size and scope and scale of the projects you're working on. Whereas, sitting in a room and in my first pipeline meeting that I was in, they're talking about hundreds of deals, and
right.
these deals technically, generally kind of reach fruition in like 60 to 90 days. So it's much more interactive, a lot more movement, a lot more fluidity in the capital markets, which really at that point piqued my interest. And I'd say, some of the skills were transferable, but not immediately, in terms of what I had coming from an engineering construction background coming into real estate. But what I honed while I was in business school was really the understanding financial modeling and underwriting, and I brought some of that with me based on what I'd learned in school. But definitely that was the initial point of focus coming in. You start as an analyst, just sitting behind a computer, underwriting a ton of deals and
crunching numbers.
Crunching numbers and putting in and learning how to pitch the deal, learning how to explain the deal to a third party, so that they can, the goal at the end of the day, when you whittle it down and on the capital advisory side, is taking a very complex transaction with a lot of moving pieces and being able to tell a story that someone can understand and get their arms around in 5 to 15 minutes, and then decide whether or not they want to spend another hour to really understanding and digging in and learning more about the opportunity.
I love that. It's so interesting because sitting on the engineer construction side and projects management is when you get the deal already done, meaning when you come from the acquisition side of things, you do everything. And I'm not talking only advisory. Advisory obviously is wrapping up things and getting the acquisition done. And then the developer, if it's a construction, obviously, you're talking about development, you're talking about getting everything ready, and working on the theoretical thing. It's not there yet. You just have to get it done on paper. And once it's already started construction, you have your people looking over it. You have to be on top of it, obviously, but your work is done and you have to move on to your next acquisition in order to move your business forward. So interesting. When you sat on that table in the very, very beginning, what type of deals came to the table? Those many, many deals that came to the table and you had to crunch numbers underwriting. What type of deals were there? What asset classes? Only multifamily?
No, it was all asset classes. So we were generalists. So worked on multifamily, retail, office, some industrial, some hotel, some single family development. As in the early 2000s, mid 2000s, we actually got into the condo conversion craze that went across the country. So worked on a number of condo construction deals, right before the Great Recession. I think we did one of the last Lehman balance sheet deals.
Wow.
for a big master plan community in San Diego, in southern San Diego County, for a client of ours, where we did like $170 million recap of several thousand acre master plan community for them. So we were really generalists and still are generalists, just really trying to help our clients grow. The way I kind of look at, especially on the advisory side, our business is my goal is to really get our clients out of the capital raising business and give them the freedom to focus on the things that at the end of the day make them money, which is finding deals and executing on the deals. Capital is really the lubricant for the oil in the engine that keeps everything going forward. And obviously, if you don't get it right, nothing works. But if you can rely on somebody to really focus on you and help you find the capital to help you expand and move forward with your business, you can really focus on the things that make you money, which again is finding the deals and executing on the deals.
You know what? It's so exciting, and moving along to where you guys are today, just like you say, and you are in so many asset classes that require so many skill sets, so many different type of skill sets, and connections and type of, connection to the deal makers, to the operators, to the sponsors, and then go find the capital that is interested in those deals, and then do the underwriting. Obviously, you need probably different staff members that require different skill sets in order to get those, crunching the numbers done. Can you talk about that a little bit, about the process that you have to go through in order to get the deals, crunch the numbers, the different type of asset classes, et cetera?
Yeah, it definitely, on the one hand, you need to be the extrovert to be out there marketing, pitching, selling, and bringing in business. You need to have the skill set once you get in front of that client to be able to show your knowledge and expertise and ability to execute the required financing raise or capital raise for them. And then you need the analytical skills to be able to underwrite and package. And then again, the extrovert knowledge of going out to the capital markets and understanding which capital sources are the right capital sources, not only for the deal itself from a returns or fit standpoint, but also we oftentimes, especially on the equity side, we play matchmaker. I mean, I create marriages on the equity side. So you really need to understand and be able to know the personality of your clients and the personality of the capital to make sure that there's a fit. Because when a deal goes bad, 9 times out of 10 it goes bad because the partners don't see eye to eye on something that comes up.
So much is about people.
It becomes really about people. So it's really understanding the capital and the types of capital, and it's as simple as does the sponsor have institutional practices in the way they do business that can translate to an institutional partner that's going to require certain reporting. It's as simple as that, to down to, are the two people going to see eye to eye? It could be two perfectly good people that are very skilled at what they do, but they just don't get along or won't get along. So a deal is not going to make them get along and aren't going to want to be together as equity partners. So a big portion of our business, especially on the equity side, is matchmaking with the right groups.
Tell me something. You just mentioned that you guys are boutique, right? How many people you have in your firm?
We have 5 people in the company.
Wow. And so you have, meaning each person have to be really skilled, and obviously you have a lot of knowledge because you work in all the places that you work for. And I saw your resume on LinkedIn, pretty impressive. You've been around, as we say. What I want to ask you is about your deal size that you're after, because that would determine what type of capital you guys go after.
Sure. So again, this was part of the transition to opening my own business and really formulating a business plan for what we wanted to do. I didn't want to be everything to everybody. Just be out there and just trying to, for lack of a better phrase, kind of eat what you kill. I wanted to be a specialist in an area and attract a certain type of client. So I decided to create a box, and I said, we're really not going to work on anything under 20 million that requires less than $20 million in capital unless it's for an existing client. If we have an existing client, we'll finance whatever they need. I mean, we've done a loan as small as $800,000 for a client. That becomes part of service. But the initial interaction, the initial deal that gets us started with a client has to require at least $20 million of capital. And we only work with professional real estate investors and developers. The family that owns an apartment building and needs a refinance is really not our client. We want the group that is either experienced and has a track record and growing, or just broke off from an institutional group and starting up and is really looking to be active. Most of our clients do 3 to 5 deals a year at minimum. And so, we don't necessarily get to do all the financing for all the deals our clients do, but if they're active enough, then that gives us a good place to focus. And if we invest time in building the relationship, it's gonna come to fruition and bear fruit in terms of fees or other opportunities.
Tell me something. Any specific location you guys are focused on?
No, but most of our clients tend to be Southern California based. So, I haven't been, again, one to just call people randomly in Ohio and say, hey, let us work on your deal. Most of our clients are West Coast based and we follow them throughout the country. So I'd say the vast majority of the business we do is Western US and kind of the South, Southeast. Very few of our clients extend up into the Northeast. It's just its own world and its own ecosystem up there.
Absolutely. I can relate definitely, because it's a whole different culture, obviously, and you have the advisory firms that are focused over there, and you guys are over here, in LA.
And there's enough. There's enough for us. There's enough for us to be plenty busy with that kind of geographical and client focus. And my goal for our company was not to be a national platform. Once you get to a certain scale, I mean, at one point we were 8 or 10 people. I found myself that you start becoming very removed from the clients and the deals. And while it's fun to grow a business, I really enjoy the deal making aspect of it a lot more than managing a business and managing a business for growth. So it's just a different approach and a different mentality, I guess.
You know what? When you deal with that kind of capital, and you said like 20 million, north of 20 million, in terms of raising equity, et cetera.
Yeah.
You deal a lot with semi-institutional, institutional investors. Can you tell us a little bit about the difference in the experience of raising capital, from family offices versus the institutionals? What type of relationships you have to build? What type of matching you have to find those type of investors?
Yeah, so for the most, I'd say the most part, not the most part, almost everybody we deal with on the capital advisory side, whether it's private capital through the institutional capital, they'll have real estate professionals working for them. So in that side, on the capital advisory side of our business, we're always dealing with real estate professionals. When you're dealing with the family offices, the capital is not as consistent and the focus isn't as consistent, and it gets there's a lot of outside factors that will impact the availability of capital and their desire to do deals that aren't necessarily related to real estate. Take a family that invests in something, made their money outside of real estate, have a portion focused on real estate, and their other businesses require more capital. So, or they, we have a family, we've worked with families that offshore, for example, are based offshore, have been investing in the US, and during COVID, couldn't do deals in the US because they were restricted from traveling to the US. So nothing to do with the deal or the real estate. It was just the way they are structured and set up. Whereas if you were US based and you were an institutional firm that had offices in New York, LA, Dallas, you're still doing deals and still able to do business. So these types of risk factors come into play oftentimes, and especially with foreign capital. Exchange rates matter. Taxation changes in tax laws have a big implication on their ability and desire to continue to invest in the U.S. and then again, what's happening locally for them in their market, where sometimes it creates the catalyst for them coming to the U.S. Where we're working with families in Australia, for example, that were in the lending business in Australia. So the construction financing business isn't as developed with the banking system in Australia, and so a lot of construction debt ended up going to debt funds and private investors. Started with private investors and grew into debt funds. And initially, those funds were able to get double-digit 12 to 15% yields on construction debt. So there was little desire and interest for them to come invest in the U.S. Whereas today, those yields have compressed significantly with increased competition, both locally and internationally, kind of investing in Australia. And now those 12 to 15% yields have become 5-6% yields. So 5-6% returns on equity isn't as attractive as it used to be. So they've been interested in doing more investing in the U.S. So the family side of the business is a lot more nuanced than the institutional. But on the flip side, if you're able to attract that capital,
much more consistent,
more relationship oriented, can be a long-term capital source and much more flexible.
Very, very interesting. You've mentioned before that you guys invest alongside with some of the investors. What type of deals you guys are going to go after? What would you find interesting?
So to create a very distinct and distinct framework, because we're on the one hand, we're on the capital advisory business. So if I show capital a deal, I never want them asking me, well, if it's such a good deal, why aren't you doing it? So early on when I started the company, I saw an opportunity in multifamily. So we started the company in 2011. And at the time, a lot of our clients were asset rich and cash poor. A lot of them made it through the Great Recession by investing their liquidity into their existing deals. And in order to move forward, needed to bring on capital partners. So we decided to focus on multifamily, ground up, and deals that require 5 to 15 million of equity. So just below the institutional threshold and higher than what your typical syndicate can put together in terms of equity. So our average, we've done just under $200 million of investing over the years in ground up multifamily, about 20 deals. So an average deal size of an average investment of $9 to $10 million, which is right within the strike range of what we're doing. And then geographically, our focus has been the western side of the US. So Texas West has been our focus. We were early into the secondary markets, continue to focus on investing in the secondary markets throughout the US. And we've also over the years started investing in senior housing. So we've done some ground up development of assisted living and memory care projects in Arizona and California specifically.
You guys are really spread out in a nice way. And I love the way you guys look for the good meat. Tell me something. I want to shift gears a little bit and talk a little bit about what's going on today. Obviously,
Sure.
we all know we just started talking about it right before we started recording today with this current wave of COVID. And hopefully by the time that people see this interview, it's gone. But
Yeah.
we don't know that. But we do know that things are crazy and things in the world shifted for so many of us. The question is what you guys saw during this whole period of COVID, this pandemic, and what do you think about the market today? And there's a lot to talk about. And obviously, from this point of view of capital markets, you feel where the money is going, where capital is being, where capital is being deployed. So
Yes.
that is a very interesting conversation. Let's get into that a little bit. If you could give us a little bit of your take on that.
Sure. So fundamentally, real estate's has been and continues to be in a good place. We, as an industry, we haven't binged and we haven't seen the excesses that created the Great Recession. The capital markets have been, for the most part, constrained. We're not seeing, it used to be that, pre-Great Recession, I would tell you, every other deal we did, we're like, wow, that's crazy. I can't believe they're willing to do that, whether it was super low rates or super high leverage or both oftentimes in terms of the type of capital. So we are seeing constraint. We're not seeing groups move away fundamentally from their underwriting or loosen their underwriting standards to the point where it's creating additional risk without any sort of return. So fundamentally, from a capital standpoint, I think we've been constrained, and I think for a large part that kept that, along with obviously the government stimulus, helped keep the industry afloat and help it manage through to where we are today over the last couple of years. I think fundamentally we are at a very good place today from a real estate standpoint. The last 2 years, we've seen the challenges of COVID to especially the consumer-facing industries. It accelerated some of the trends that we were already seeing going into the recession in retail, and on the challenging side, on shifting to industrial. On the positive side, housing has been a big factor and a big focus for the last 10 years, and it again accelerated the demand for single family housing, which we've seen the last couple of years. But overall, based on where the economy is and the constraints that we've seen lenders kind of maintain in terms of their underwriting in lieu of all the capital that's out there, have kept the industry very healthy from a fundamental standpoint.
Tell me something. When you talk to investors nowadays, if you could tell me, like, okay, pre-COVID and today,
Sure.
talking to an institutional investor who you have a lot of experience with, and you talk to them and you say, okay, and they tell you, I want X type of deal with this amount of capital. These are my requirements, IRR wise, hold period wise, whatever. And then post-pandemic, same investor, same type of investor, what type of capital, what type of IRR, what type of expectation, hold period, etc. What do you see?
So the type of capital that they're providing didn't change. They very
Same
likely same amount, raised a new fund, probably looking for bigger deals. So if they had a $1 billion fund, they probably raised $1.5 billion or $2 billion in the next fund. So they're generally looking for larger deals or clients where they commit more capital to. So maybe do something more programmatic with a sponsor, where before it was, let's just do one deal and then figure out follow-on deals. In terms of returns, I think the returns are slightly lower. So call it 200 basis points less for a multifamily development deal than what it was pre-COVID. And I think now, because of the amount of capital that's out there, they're actually willing to get involved with deals a lot earlier. So again, taking the example of a multifamily deal, we would have pre-COVID, it was, hey, give us a call once you've got your building plans kind of 70% complete, and you've got a GMAX or a contractor that's close to providing a GMAX contract, firming up the numbers at that point. Give us a call and we'll get interested, and we'll fund once you're ready to pull permits and get the project started. Today, it's they're willing to take pre-development risk. So and even land in town.
They will be willing.
They're willing to. They're willing
so
to
much
take
capital out there, unbelievable.
They're willing to, for the right sponsors and right deals.
Right.
They're willing to take. They're willing to take that pre-development risk. So what they're not willing to do is take
pre-zone probably.
No, not zoning risk. So non-discretionary. So if it's non-discretionary, if it's discretionary approvals, that creates a different element. But if it's discretionary approval, it provides a different risk element. If it's non-discretionary and it's really just going through a process that's going to take another 12 months before you're ready to start construction, we're seeing that they're now willing to take that additional risk without getting paid for taking that additional risk.
That's so interesting. And that's on the equity side of things.
That's on the equity side.
Yes. When we talk about debt, let's talk about debt a little bit. And you are on that side as well. How much are you involved in debt? Because you said debt is senior debt, mezz. Yeah. What are you involved in? And what do you see today in terms of the environment, interest rates, et cetera, and demands, the lenders originating those loans, how easy, how hard it is, et cetera? So
it's we're again flush with capital. The advent of, or the explosion of the debt funds has really brought a lot of fresh capital into the business and stepped on the toes of the banks. The banks are still active and generally actively lending, although the larger banks have really narrowed their focus to just dealing with the super institutional REITs and very large players in the business, and moved away from serving the middle market. The more regional banks are really serving the middle market players out there. So we continue to see the banks be active. Where the debt funds have come in has really been on bridge debt, for any type of bridge debt. So whether it's land acquisition all the way through your plain vanilla light value add apartment reposition, there's a bridge lender that will price that capital accordingly, and or a debt fund that will price that capital accordingly. And then what we've seen, because of the competition in the debt fund space, we've seen them starting to focus on construction and heavier lift bridge loans, which require change of use or extensive renovations, much more than a changing carpet and painting the walls.
Tell me something. With the environment today, talking about development, I heard, what I hear in general is that people are looking for less development. There's much more, available type of deals. Obviously, it's still hard to find deals, but people are saying, I'm going to find a deal. There's still opportunities I can find instead of going into a whole development process. So, what is your take on that saying? And who is looking for development? Who is not? What is going on? So,
going into COVID, everybody kind of built up their armory and said, "Oh, there's going to be a lot of failures, and we'll have some distress, and we're able to capitalize on distress." I think the distress kind of came and went in a blink. There were some debt funds that sold some loans at a discount, but it wasn't very prevalent, and to the extent that it was available, a lot of capital was chasing it, and the discounts weren't as significant as people had expected or experienced.
It wasn't a real estate. It wasn't a real estate recession.
Yeah, and then you look at asset classes that were out of favor. So, the retail, which was already out of favor, became more out of favor. Hotels got hit significantly. Student housing had its moment for, again, about a minute. And then, and same with apartments. There was probably, there was probably a month in early 2020, maybe in April, early 2020, where the agencies, Fannie and Freddie, decided to change their underwriting. We're a little bit more restrictive, and people were saying, okay, well, we don't know what's going to happen with rent growth. Are people going to be able to, everybody was starting to focus on collections. So, there was probably a moment in time there, a very brief moment in time, where you could have bought an apartment building, which today would look like it was a steal. And then office, the great question, and
still a question, by the way.
Still a question. I personally am of the opinion that it's less of a question, but
why? I want to hear that.
Because when you run your own business, you need people around you. I don't know how you grow a business and train people and give them the opportunities to advance when they're sitting at home, working, maybe not working, being less productive at times when you need them to be. I mean, it's great that you're working at 10 o'clock at night, but that's not the time of day where I want to be reviewing your work and answering your questions. So I think
you'll be tired.
Yeah, the office.
You're not a Terminator at 10 o'clock at night.
Yeah, look, I'll work all times of the day, but I prefer to have kind of a structure and an order to my day, so that you can also put work away and enjoy other things during non-working hours, which is also something that is challenging when working from home, is creating that work-life balance. So I think long term, we're going to see people coming back to the office. The trend of stuffing as many people as possible on top of one another in an office, in an open environment, may change. And
that's what I think also. I agree with you, and I think the same way. I think that office, nobody can do without the office. The office will be back, but we'll see changes in terms of the face of the office, what type of structure, lease types, etc.
I'd see the different lease types. Again, it's a function of the landlords being willing to do so. We've been typically working, even since we've been back to the office, working from home on Fridays. I know many companies that will have a flex schedule, and so that's fine to have a flex schedule. So you'll be rotating people in and out and making sure that people are together certain days during the week, and providing some more flexibility. We definitely have tools these days to be able to work remotely and work from wherever. So that doesn't mean that you just get rid of office altogether. So even if I'm only using my office space three days a week, I still need office space. So that's my 2 cents on office. So we were actually long on office. We did actually, one of the COVID special deals that we did was an office acquisition with a client of ours. We closed it in July of 21, and July of 20, and it was a credit triple net lease to a power company, energy company, with 9 years remaining on the lease, that shouldn't have been traded at the cap rate that we bought it at, and ended up holding it for a year and a half, and actually just sold it in December of last year. And it was a home run, because our underwriting assumed that we were just going to coupon clip essentially for 9 years. an exit, and the market came back a lot sooner, and we were able to exit at a price that we thought was higher than our value on it. So,
Shlomi, I really enjoyed this. If you could tell us, and you guys could see the links out, above, below, wherever. Shlomi, if you could tell everybody where can they find you if they're, on the institutional side, or
sure.
on the investment side, or on the sponsor side of things, wherever they are, how can they find you?
Our contacts on the website. If you go to dekelcapital.com, you can find me. I've been pretty prolific in terms of my writing thought pieces and other things. So generally, if you Google my name and real estate, I should pop up as well as one of the top results. But yeah, Isha, I really appreciate you reaching out. It's been great speaking with you, and look forward to doing it again someday.
It's a pleasure. It was really interesting. Thank you so much for your time. And I wish you all the best and success. As we say in Hebrew, behatzlacha. All right. And you guys.